So, how do you really know if your mutual fund is doing well? You see a number, you think you get it, but that single number can be, well, incredibly deceiving. Today, we're going to crack the code on mutual fund returns so you can be sure you're seeing the full picture of your investments. Let's break it all down.
All right, imagine this. You're chatting with a friend, and they just casually drop this line into the conversation. I earned 80% returns. Whoa, your brain just lights up, right? You're thinking, how on earth did they do that? It sounds like they've absolutely hit the investing jackpot. But hang on a second. Does that sound a little too good to be true? This is where we need to put on our investor detective hats. Because when it comes to returns, the most important piece of information is almost always the one that's missing. And there it is, the missing clue. That incredible 80% return took 15 long years to achieve. All of a sudden, amazing turns into, well, kind of mediocre, actually. This is the first rule we need to remember. A return figure without a time frame is basically useless.
So that brings us to our first big diagnostic question, and it's all about time. Simple as that. How long has your money been invested? Because depending on your answer, the way you measure its performance changes completely. The magic number here is 1 year. That's the dividing line. Has your investment been around for less than a year or more than a year? Answering that one simple question is going to tell you exactly which path to go down when you're figuring out your returns.
Okay, time for diagnostic question number 2. This one is all about how you invested your money in the first place. And trust me, this is just as important as how long it's been working for you. So, did you put in one big chunk of cash all at once? That's a lump sum investment. Or are you doing it bit by bit, putting in a fixed amount every month? A systematic investment plan or SIP. As you're about to see, these two very different styles require a whole different kind of math to figure out what you've really earned. All right, now that we've answered our two big questions, time and style, it's time to open up the toolkit. We've got 3 main tools for this job, something called absolute return, CAGR, and XIRR. Let's figure out which tool to grab and when. The first tool in our kit is the simplest one of all, absolute return. It does exactly what it sounds like. It tells you in a very straightforward way the total percentage your money has gone up or down. Since we're only looking at a period of less than a year, we don't really need to get into the complexities of annual growth just yet. It's the perfect tool for a quick, short-term checkup. Let's make this super real for a second. Let's say you invest 25,000 rupees. You check back 6 months later, and hey, it's grown to 30,000. So what's the simple absolute return on that? Boom, it's a clean 20% gain. It really is that simple. You made a 5,000 rupee profit on your initial 25,000. So for any investment you've held for under a year, this is your go-to metric. It tells you exactly what you need to know, no fuss. But what happens when we cross that 1-year mark? All of a sudden, that simple return just doesn't cut it anymore. In fact, it becomes misleading because it completely ignores the incredible power of compounding. For that, we need a new tool. Meet CAGR, the compound annual growth rate. Okay, let's take that same 25,000 rupee investment, only this time you've left it alone for 3 years. And as you can see, it's now worth 40,000. What CAGR does is answer a very specific question. To get from 25K to 40K in 3 years, what would the steady year-on-year growth rate have been? And the answer is 16.96% per year. Now, here's the absolute key thing to remember. This is an average. It smooths everything out. It does not mean your investment grew by exactly 16.96% each and every year. Of course not. In reality, it probably shot up 1 year, maybe dipped a bit the next. CAGR just irons out all those bumps into one easy-to-understand number. Honestly, this road trip analogy is the perfect way to get your head around it. When you finish a long drive, you don't tell your friends, well, I did 110 for a bit, then I was stuck in traffic doing 20, then I hit 90 on the open road. No, you just say, my average speed was about 80. That's exactly what KGR is doing for your investment. It's the average speed of your money's growth. All right, time for our last and definitely our most powerful tool, XIRR. Sounds complicated, but it's not, I promise. See, so far, we've only talked about a single, one-time investment. But what about an SIP where you're putting money in every single month? That's where XIRR shines. It's purpose-built to handle all those different investments at different times. And the best part, any spreadsheet program has a simple XIRR function that'll do all the heavy lifting for you in seconds. So here's your classic SIP situation. You've been diligently investing 5,000 rupees a month for 19 months. Think about it. That first 5K has been working for a full 19 months, but your most recent investment has only been in the market for 1 month. So how could you possibly calculate a single meaningful return for all of that? Well, that's the exact puzzle that XIRR was born to solve.
So XIRR takes all those different investment dates and amounts, crunches the numbers, and gives us one single powerful answer, 18.79%. That is the true annualized return on your entire SIP journey so far. Bottom line, if you have an SIP that's more than a year old, this is the number you need to be looking at, period.
Okay, we've met all the tools in the toolkit. Now let's put it all together. We're going to build a simple master framework so that you will know without a doubt which metric to use every single time. And here it is. This is the cheat sheet. It's a simple little grid based on those 2 diagnostic questions we started with. So, look, if your investment is under 1 year old, it doesn't matter if it's a lump sum or an SIP, you use absolute return. It's simple, it's clean. But once you cross that 1 year mark, if it was a single one-time investment, you use CAGR to find that smooth average annual growth. And if you've been making multiple investments, like in an SIP, you need the power of XIRR. That's it. That's the whole system.
And here's one last little pro tip for you, a really neat insight. You can think of XIRR as the Swiss Army knife of return metrics. We know it's designed for the complicated job of an SIP, right? But it can also do the simple jobs. If you actually take a single lump sum investment and calculate its XIRR, you will get the exact same number as its CAGR. It really is the one tool that can, technically, do it all. So there you have it. You've got the framework. You now know how to measure your returns like a pro, and you can see right through those misleading headlines. You understand the true performance of your money. So the only question left is, now that you can read the numbers correctly, what kind of story are they telling you about your financial journey?